Look next at liquidation distributions. The first requirement is that both the transferor and the transferee must be grouped resident companies. The further requirement is that the transferor must dispose of all its assets other than those retained to settle debts. And the final requirement is that this distribution must be effected in anticipation of or in the course of the liquidation, winding up or deregistration of the transferor company, which is essentially to be completed within 36 months. If you look at section 41 sub 4, it will detail all those steps which must have been completed within 36 months. They include the rendering of all returns to SARS unless you can negotiate an extension with SARS. There are some ancillary requirements. The shares in the transferor company must ultimately be disposed of in consequence of its liquidation. The transferee must not assume any liabilities of the transferor which were incurred within 18 months prior to the transaction, unless those liabilities were incurred by the transferor in the ordinary course of a business which is transferred as part and parcel of a liquidation distribution. If you comply with section 47, the usual consequences will apply. There will be a transfer of the transferor's assets at base costs, an acquisition by the transferee at base costs, and the usual dispensation in relation to trading stock, capital allowances, and 24C allowances will apply. There will expressly be no capital gains or loss in the event of the eventual disposal of the shares in the transferor company, in respect of that disposal occasioned by its liquidation. There will be allied relief from VAT under section 8 sub 25 of the VAT Act if these transfers were effected on a going concern basis and both parties were registered for VAT. Now that's also a cue for me to say something about ancillary relieving measures. There are ancillary provisions under the Securities Transfer Tax Act, under the Transfer Duty Act, and under the VAT Act, which give you linked relief where a transaction complies with the corporate rules. Yeah? For VAT purposes, your governing provision is section 8 sub 25. If you effect a transfer of assets pursuant to the corporate rules, and that transfer is effected on a going concern basis, such as ordinary governed by section 11(1)(e) of the VAT Act, yeah? Then section 8 sub 25 provides that the supplier, the transferor, and the recipient, the transferee company, shall be taken to be one and the same person. Now, if you think your way through that verbiage, what they're in effect saying is, this wasn't a supply. Yeah? It was a supply. The supply, notion of a supply contemplates something going from one person to another. And if your supply and the recipient are one and the same person, well, it's no supply. Yeah? Notwithstanding that it's no supply, yeah? If you comply with 8 sub 25, I understand that SARS will give the buyer, yeah, the transferee, an input tax credit in respect of costs associated with the transfer of the assets, yeah? Which is profoundly illogical, because there was no supply. Okay? But yeah, it's a kind of justice, so we won't argue with that. Okay? Right. I said something earlier this morning about choosing between sections 47 and section 45, where you're doing a vertical transfer of assets from a subsidiary to a holding company. Yeah? Transfers at full value from a subsidiary to a holding company at market value are not liquidation distributions. They are not governed by section 47. They are governed by section 45. And you may wish to ensure that your vertical asset transfer is governed by section 45, because if it were to be governed by section 47, remember, the clock's ticking. You must complete the winding up process within 36 months. This is particularly an issue to be borne in mind if your transferor subsidiary has outstanding claims against it and you're uncertain as to whether or not these claims will be settled within 36 months. Okay. We turn next to section 44 and amalgamation transactions. An amalgamation transaction is defined at some length in section 44.1. It is first of all a transaction effected between two South African resident companies. Pursuant to that transaction, one company, called the amalgamated company, think of it as the seller company, dispose of all its assets other than those retained to settle debts to another company called the resultant company. Think of it as the buyer. Yeah? This transaction is within 36 months to culminate in the termination of the amalgamated company. Now, what's involved in that termination is worthy of some focus. When the amalgamated or seller company transfers its assets to the resultant company, the resultant company will typically impart, as payment for the transferred assets, assume liabilities of the amalgamated company. As to the balance of the purchase price, the resultant company issues shares in itself to the amalgamated company. What follows thereupon is a distribution by the amalgamated company to its shareholders of those newly acquired shares in the resultant company. When everything is done, what is your picture? Yeah? The amalgamated company liquidated, gone. Yeah? The former amalgamated company shareholders are holding those shares which were distributed to them by the amalgamated company. They are holding shares now in the resultant company, and they've joined the ranks of the resultant company shareholders. Commercial lawyers, yeah, find amalgamation transactions very difficult to draft. Yeah? The key to drafting the principal agreement in an amalgamation transaction is to realize this is just another agreement of purchase and sale, in which you pay for the transferred assets in part through an assumption of liabilities, and as to the balance of the purchase price, an issue of shares. Yeah? Okay? But then do remember the amalgamated company must be wound up within 36 months and those shares must be distributed. Okay? What are the consequences if you qualify for Section 44 relief? They are familiar consequences. Yeah? The usual dispensation in relation to transferred assets. They go across at base cost, they're acquired at base cost. Trading stock goes across at tax values, it's acquired at tax values. No recoupments. Carry over Section 24 allowances. Okay? There is a proviso here. The consideration for all these asset transfers must be limited to an issue of equity shares and or the assumption of permissible liabilities. Okay? as to what might permissibly be assumed by way of liabilities. The resultant company can assume debts of the amalgamated company that were incurred more than 18 months prior to the asset transfers. It may further assume debts incurred within the 18-month period if they constituted by a refinancing of previously incurred debts, or alternatively, if these debts arose in the ordinary course of a business undertaking transferred as a going concern, and these debts were not incurred to fund the amalgamation transaction. Okay? As regards the base costs of the shares acquired in the resultant company by the former shareholders in the amalgamated company, yeah? It's substantially the usual procedure. The shares that are acquired by the former amalgamated company shareholders in the resultant company will inherit the base costs of the old shares in the amalgamated company. Yeah? At the level of the resultant company, well, that we've dealt with, we can leave that. There's a final issue to fix on. That distribution by the amalgamated company of shares in the resultant company, yeah, which you undertake in anticipation of liquidation, that distribution will in essence be a tax non-event. There's no dividend tax, regardless of the fact that the distribution is effected in favor of natural person shareholders. Okay. Yes.
Could you just clarify the issue with regards to contribution tax capital in the resultant company?
Yeah. From memory, yeah? From memory, it should be the same mechanism as we encountered in the context of section 42, yeah? The accretion to the contributor tax capital of the resultant company should be limited to the base costs of the transferred assets. In the same fashion as it was limited to the base costs of transferred assets where you effected a share issue pursuant to section 42.
So if I rephrase that, the effect is that the undistributed reserves, which represented the net asset value of the original of that company, will remain dividends when they won't be in capital.
Yes.
So that's the effect.
Yes. Yes. You'll be able to affect the resultant company will be able to affect a distribution of its increased reserves, yeah, represented by the net asset value of the transferred assets, okay, without giving rise to a capital distribution unless and until it has drained those distributable reserves to such an extent that all that is left is contributed tax capital determined by reference to the base costs of the transferred asset. Okay? It's important that one understands these contributed tax capital rules. I've had the experience of assisting in a section 42 asset for share exchange, and the accountant coming to me a year later, yeah, saying, hey, the company's declared a dividend, but it can't do so. This is capital. Now, first of all, it's nonsense, yeah? This isn't a no par value era. And secondly, it was not even contributed tax capital. Yeah? Okay. All right. I want to sound a cautionary note in relation to amalgamation transactions and the Companies Act. Yeah? The first is that an amalgamation transaction is a so-called fundamental transaction under Chapter 5 of the Companies Act. That attracts a number of onerous requirements. Yeah? One of which is that before you embark on the transaction, you have to obtain an independent expert's report, yeah? A fair and reasonable report, which must be submitted not only to your shareholders but to SIPC. Yeah? The other is that you have to effect these transactions by way of special resolutions. Yeah? There are further intricacies. You to note, amongst other things, that the definition of an amalgamation or merger in the Companies Act is substantially wider than the more restrictive definition in the Income Tax Act. The definition under the Companies Act allows for some shortcuts. If you want rollover relief under Section 44, don't take those shortcuts. You will not have complied with all the elements of an amalgamation transaction as set out in the Income Tax Act if you take the company law shortcut of issuing shares from the resultant company directly to the shareholders in the amalgamated company. That's the Companies Act shortcut. You've got to issue the shares not directly to the shareholders in the amalgamated company, but to the amalgamated company itself, which later distributes them, and you end up in the same position. But you've got to go the long way around if you want rollover relief. Okay, that brings us to very near the end. Do you want to pause a little? Have I been flogging you unduly? Yeah? Or are you still focused? Okay. I must say you are a very resilient audience. Okay then, Section 46, unbundling transactions. The first prerequisite is that the unbundling company, and the unbundling company is that company which affects the distribution of shares in its subsidiary, must be a resident company. Okay? It is further required that all of the equity shares of the unbundled company, that is the company whose shares are being distributed, that are held by the unbundling company, must be distributed pro rata amongst the shareholders in the unbundling company. If the unbundling company is, if the unbundled company, the slide should read, if the unbundled company is either listed or to be listed within 12 months. If the unbundled company is not listed or destined to be listed within 12 months, then the shares in the unbundled company must be distributed to a shareholder in the same group. And please note again, where the slide shares unbundling company, it should read unbundled company, and do forgive me for that. And finally, if you are acting pursuant to an order of the Competitions Tribunal, then you may effect a distribution of shares in the unbundled company to the shareholders in the unbundling company without regard to whether or not the unbundled company is destined to be listed. And pardon me, this is all a bit of a minefield, and you have to mind your P's and Q's and carefully distinguish between the unbundled and the unbundling company. I must have drafted that slide after the third brandy. I want to give you an illustration of an unbundling transaction taking place in an unlisted context. Yeah? The position at the outset is that Holdco has an wholly owned subsidiary Subco 1, which in turn holds all the shares in Subco 2. What you're permitted to do under Section 44 in cases where Subco 2, the unbundled company, is not destined to be listed, is only to have Subco 1 transfer those shares to Holdco. Okay? By way of an aside, just listening to these rumblings in the background, Many years ago, going back to about 2001, I was one of a team from Deloitte doing a seminar in the Rosebank Hotel, yeah, on, would you believe it, the corporate rules. There was an interaction between the audio system at the Rosebank Hotel and the flying squad's radio. Okay? So you'd be in the midst of an earnest explanation of a profound point, and you'd hear squealing tires, swearing, acceleration. It was a very, very exciting day. And somehow the Rosebank Hotel couldn't resolve the problem. We lived with the flying squad the whole day. I don't know whether they heard us. And if they heard us, I doubt that they absorbed anything about the corporate rules. Presumably if heard them, they must have also heard us. You know, these be truly crossed wires. Yeah? Yeah. Sorry?
The corporate rules was the reason for the cursing.
Okay. You mean they were cursing because, oh hell, there was that voice again. Wie is die donder? Bliksemom. Okay. If you engage in an unbundling transaction, the consequences will be as follows. The distribution of shares in the unbundled company by the unbundling company is to be disregarded in determining the taxable income or assessed loss of the unbundling company. In other words, as far as the unbundling company is concerned, its distribution of the shares in its unbundled subsidiary is a tax non-event. Yeah? Then follows a little complication. If, let's go back to the diagram. If Subco 1 unbundles itself of its shares in Subco 2, yeah? What happens to the value of the shares in Subco 1? The corresponding reduction in value. Now there are rules that fix upon this corresponding reduction in value. Those rules say, yeah, that to the extent that the value of the shares in Subco 1 has been reduced, you must reduce the base cost of the shares in Subco 1. If they suffered a 25% reduction in value, you must reduce Holdco's share-based costs in Subco 1 by 25%. Whatever you take away from the base costs of the Subco 1 shares, you must add to the base costs of the Subco 2 shares. Okay? Last leg, a very short leg. We'll say nothing about Pistorius. Pardon me. Last leg. Substitutive share for share. Substitutive share transactions. I pointed out to you earlier, you're having the fit of the giggles, are you? I pointed out to you earlier that Section 43 up until April this year covered a wide terrain. It's now limited to an exchange of linked units preparatory to taking up shares in a REIT. Yeah? The other matters that used to be covered by Section 43 have now been subsumed under paragraph 12.2L of the 8th schedule. 12.2L says that if you do things like a share split or a share consolidation, or you convert members' interests in a CC to shares in a company, or you convert a co-op to a company, in all those cases, the disposal of your old shares or members' interests will not be a disposal for CGT purposes. This is subject to a proviso. The proviso is that in consequence of the acquisition of these new shares, there must be no material alteration in your rights. Okay? And that is where 11.2L stops. It doesn't tell you, like the old section 43 used to tell you, that you must carry over the base costs from your old shares or members' interests to your newly acquired shares. But that is no doubt implicit in paragraph 11.2L. Okay? Right. Now that